All right, so in this session, we're going to focus on the learning. I think that's study unit 1. All right, because you guys now have the year module, and all right, so that gives us more time to prepare for the assessments, because there's a lot of work that needs to be covered. And previously, when it was still a semester module, it was quite squeezed in. But now, the whole year, there's an advantage that we have an opportunity to clearly understand the stuff and do well in our assessments. But there's also this challenge where now, if we don't do well, we might have to repeat for the entire year. I'm not sure yet if somebody would fail for the entire year. They're gonna fast track you into a 1 semester arrangement the following year. I do not know about that, but that would be quite reasonable. All right, so today we're going to focus on production. This is a very soft topic. So this is study unit 1, and it's the introduction to macroeconomics. So we're talking of production, income, and spending. So I'm going to follow the slides that we have, that I've prepared for you. Then later on, I'm also going to share some questions with you in our Telegram group, which you can use for practice purposes. All right, so you guys already know the differences between macroeconomics and microeconomics. So it is a requirement at this level that you need to be able to identify which issues are going to be macroeconomic issues and which issues are going to be microeconomics issues. So when we talk of macroeconomics, it's not just the economics of a country, right? Of a nation. It's not just the economics of a country. Or when we talk of microeconomics, we're not just referring to the economics of an individual or an individual person or an individual company. But the term macro refers to the whole, right? No. It doesn't refer to the whole, but in macroeconomics, when we talk of macroeconomics, we're referring to the whole unit, and it's the whole unit, right? And so whatever that unit could be, when we look at the entire unit, then that's macroeconomics, right? Then if we look at the portion, just a portion of that entire unit, then that is micro. All right. So if the entire unit we're looking at here is the national economy, right? Then if the national economy is the entire unit we're looking at, then this is the macroeconomy, right? Then a portion of the entire economy could be the motor car industry, right? So when we look at the motor car industry, then this now becomes a portion of the bigger thing. So that becomes macroeconomics. But let's look at the economy of South Africa, right? Then the economy of South Africa is contained in a global economy, all right? So this is South Africa. Now, South Africa, as you can see, is no longer the entire unit. The entire unit is the global economy. So when we study the economy of the entire globe, the entire world, that's going to be the macro, because the unit, the entire unit defines what's macro. Then a portion of that is now the South African economy. And studying the South African economy in the context of the global economy, now the study of the South African economy becomes microeconomics, right? Because it's just a portion of the entire unit. So microeconomics and macroeconomics depends on from what perspective do we say this is macro, this is micro. But in most cases, because economics is studied from a national perspective, so macroeconomics generally refers to the whole economy in a country, right? So we could talk of things like your GDP, your inflation, your national employment, all right? Because now, generally, like I said, generally we studied from the perspective of the entire economy. Then within that economy, we're gonna have parts of the whole economy, like the fuel prices. If we talk of the rise of the fuel prices, we're not talking of inflation, because inflation is the general rise in the price of goods and services in the whole of South Africa. Not just one good in South Africa. So if there's a rise in the fuel price, that's just fuel price. But if it is a rise in the general economy, then that's going to be inflation. Remember that. But if we are looking at South African economy, and there's only we're looking at the South African economy as part of the global economy. So an increase in the prices in South Africa is just a part of the micro, because we're looking at the whole world where the prices are stable, but then prices in South Africa are rising. So that's just micro. But remember, we're going to focus on our economy here in South Africa. So we look at wages for factory workers, the prices of agricultural products. So that's going to be microeconomics. All right. Now, our module is macroeconomics. So I understand that this year, you guys, most of you could be registered for both the introductory macroeconomics, that is X1501, and macroeconomics, because these become year modules, which I believe is going to help you a lot in understanding the content better. All right, so when we look at the economy, right, the economy of South Africa, we can identify what we refer to as three major flows. All right, so these flows have to do with movements of goods and services, as well as the movement of income, right, in the economy. So we're looking at goods and services in the economy, how they flow in the economy, then the movement of income in the economy, how that does flow in the economy. So we have production, right, which is about producing goods and services. Then we have the income, which is another flow. So the first flow is production. Right? The second flow is income, when people earn, what people earn from utilizing the factors of production. All right. So you remember that your production, we combine those factors of production. Remember, we have 4. You can try to split them into 3 or 4 or 5, whatever you want, but we have 4 factors of production. Okay. So when we combine these to produce the desired needs and wants of society, that's the first flow. But then the owners of the factors of production, remember that they get a return for this, for employing their resources. So that's going to be income to the owners of the factors of production. And of course, those owners of the factors of production also have needs, so they're going to spend on those needs. Right. So we have 3 flows. So if you look here, it's going to be all combined, right? Because what you produce, you're going to produce using factors of production, then there's a reward for those factors of production. Then what is produced, we now have income. We're going to spend that income on the things that have been produced. All right. So production, spending, and income is more or less the same thing. All right. So we would expect in an economy to have production, the total production being identical to the total income. And if people spend all their income, then that is also going to be identical to spending. You spend on those goods produced, and the production gives you income, which you spend on the goods. So it's more like a flow, a circular flow. Right, so let us look at a diagram that gives us an idea of those. So those are the 3 major flows in the economy. So you have production, right? And those are the 4 factors of production. And from that production, you remember you're going to employ your factors of production, and then you get income from employing the factors of production, right? So for your rent from land, for wages, labor, interest, capital, and profit from the entrepreneurship, then all that income is used to spend on goods and services. So those income could be spent by households, by government, by firms, by also the foreign sector. All right, so this is all spending. But we're also going to spend on those goods and services that we have produced. So these are the 3 major flows in the economy. All right. So this is rather a very soft topic. but also one that is very important, because now what happens is that the students will somehow get confused. Right, now we come to the concept of stocks and variables, stocks and flows. So these are variables in economics. So we have stocks and flows. All right. So a stock is a balance. A flow is a movement, right? Movement in or out. All right. So a stock is measured at a particular point in time. All right. It's more like a bank balance, whereby you have money in and money out. Then after those movements, now you look at what's left remaining. So what's left remaining, or what's the balance at the end, is going to be a stock. So a stock is measured at a point in time. For example, you won't say how much is in your bank account from 1 January to 31 December, because it keeps changing, right? Daily, it changes daily. There's money in, money out. So you can't say over a period of time, how much money did you have in your account? Because the money keeps on coming and going. But you can say at a point in time, how much money do you have today? Right. Then that's a point in time, because you need a standing balance. Then a flow is measured over a period. You can say how much money went into your account from the 1st of January to the 31st of December. Now you can say, oh, there was so much that went in and there was so much that went out over a period. Right. So I'll give you examples of flows. So stocks are influenced by flows, right? So there's a causal relationship between a stock and a flow. Okay, so I'll give you an example of a dam. All right. So there is a river that flows into a dam, and there is our dam. All right, so there's the water. And let's say that we also release some water out, maybe to help with farming and so forth. So there's an inflow of water. Then there's an outflow of water. Then there's the body of water that is remaining in there. All right. So this body of water can be measured at a point in time. Like on this date, there was so much water in this particular day. All right. We can do that. But we can't say for the entire year how much water was there, because it keeps differing. It's balance going up and down. And this is the flows. So there could be inflows, there could be outflows. So if you look, the stock is a result of how much went in and how much went out. Then you have the balance. So that is why we say flows influence stocks. Right? But stocks are not influenced by flows, but flows are influenced by stocks directly. Right? So there's causality there. Like your bank account balance, how much money goes in is an inflow, how much money goes out is an outflow. Then you have the balance. So that balance is a result of how much went in and how much went out. So that's why we say your stocks there are going to be influenced by the flows. Right, brilliant. So this is ratios and nominal versus real variables. So you need to know the difference between nominal versus real variables. So real variables are adjusted for inflation or changes in nominal prices, whereas nominal variables are not adjusted for inflation, right? So you need to know the difference between a nominal and a real variable. So what I did here is that I gave you examples of stocks as well as flows, right? So flows is anything that is going to come in or go out. Then a stock is what's left remaining. Right, so it's measured at a point in time, and this is measured over an power. It's influenced by flows, it's not influenced by stocks. All right. Represents the balance, represents the movement. So examples could be your assets, your capital, your population. Remember, your population is about people being born and dying. So the population is what's left remaining. Right. So the actual movement is the birth and the death. All right. and so forth. All right, so you can get those examples from that slide, or also from your own real life examples. Right now, let's look at the general economy of South Africa and the various people participating in the economy. All right, various individuals, various participants in the economy. So we have something that is referred to as a household. A household is not your home, your home and the people that stay there. A household is an independent economic decision-making unit. So a household is about making decisions to buy, right, to earn an income. A household earns one income, right, and spends that income. Right, so they make decisions on, if you make decisions together as one and spend together, benefit from the spending together, then you are a household. So a single person, a person staying alone, could be considered a household if they have their own income and they have their own spending decisions, independent decision-making capacity. How much do they earn? How much do they spend? As long as they are independent decision makers in the economy, they're going to be a household, right? Then you have firms. So these are private entities that are seeking profit, any operation that is seeking profit, not a household, but just an operation that seeks to make profit, that is going to be a firm. Now, in an economy, you generally have people who produce for profit and those who consume. So basically, these are the two basic sets of participants in the economy. They are very basic. The backbone of the economy, and they are also the original players in the economy. Before government was established, before international trade was established, it just has people staying together in a community. All right, one has the money, and the other has the goods. Then they have to exchange. So that was the some form of economy, a market back then. So these two are central to the economy in the way it works. But of course, now we have developed, so we have government. All government entities are going to be included. Your government entities, your government agencies, your ESCOM, your PRASA, all that is government. Foreign sector refers to other players outside the country. So it could be imports, or it could be exports. So we are now expanding our boundaries to deal with people outside of South Africa. And of course, because of that, there's going to be a need for an exchange because one has and the other doesn't. Okay. So exchange refers to trading. Exchange, where you have something and that somebody wants, and you want that something that they have. So exchange allows for specialization and division of labor to occur. So one of the things that you need to know is I want you to be able to look for the advantages, right, and disadvantages of specialization. So it's the advantages and disadvantages of specialization and division of labor. So you need to have them written down. We say that because although they've not always been being asked in the assessments previously, but now because it's a year module, all right, and you're only going to be doing like two topics per assessment, so there's a wider scope to ask almost everything. So you have to know as well what are some of the advantages and disadvantages. And remember that specialization and division of labor allow for exchange, right? Because it means you're going to specialize in production of good A, and somebody else is going to specialize in the production of good B. Then you have to exchange because you're not trying to be self-sufficient. Right, then we talk of factor markets. Remember, we have factors of production. All right. So factor markets is where where individual players or participants buy and sell factors of production. Also, you can buy land, labor, capital, and entrepreneurship. If you can buy entrepreneurship, which is to some extent possible. So these factor markets, you have buyers. Buyers need to use these factors of production. So in a factor market, the firms are the buyers because they need the companies, or let me say the companies, but basically we refer to them as firms. So the firms are the buyers because they buy land, they buy labor, they buy capital, so that they can combine that into production. Right. But once they buy in the factor market, then they go and sell the goods and services they produce in the goods market. Right. So if you look at firms or companies, they're going to buy, they are buyers in the factor markets. And after combining the factors of production to produce goods and services, they are going to be sellers in the goods market. Whereas households are going to be buyers because they buy goods in the goods market. And they're going to be sellers because they sell resources they own. So they sell in the factor market, then they buy in the goods market. So these are things that need to be very clear to you in your understanding. All right. So remember what households buy in the goods market, what the households sell in the factor market, what is it that firms buy in the factor market, what is it they sell in the goods market. So because the examiners are going to play around with those things, like this entity A did A, B, C, D, so then they will come back to these concepts. So this firm was a seller in the goods market, a seller in the factor market, a buyer, and then you need to know what a firm is doing in each market, all right, so that you can apply that appropriately. All right, so these are factors of production, things that I would expect you to cover these in X1501. So your land, labor, capital, and that. So I wouldn't go into depth on that. Now let's look. Remember, we said we have production, income, and spending. All right, so I'm saying here we have production being equal to income. Right. And why is production equal to income? Because the value of the things we produce, right, the value of the things we produce is represented by the payments we make to the owners of factors of production. In other words, if you want to think in terms of what is the cost of something, so let's say this, right? Let's say a farmer has 1 ton of maize to sell, right? Okay. So what happened is that this 1 ton to sell, he bought this land, all right? All right. So the price of land has to be paid for by the production. So let's say the portion allocated to this 1 ton, let's say that the 1 ton is being sold for, let's just say 100,000 rand. Okay. If he's renting, if this guy is renting from somebody, then the total cost of 100,000 is made up, let's say, of the rent is 20,000. Right. So that is the rent. Then you employ people, so that's labor. Right. Then you pay them 40,000 in total. Right. So remember, these figures are coming from my head. And then let's say you use machinery, and the cost of the machinery used is 20,000, right? And then we're gonna sell this for a profit of 20,000, right? So in total, that's going to be the 100,000, which is being the cost of this 1 ton. So the value of production is 100,000. So production there is 100,000, but it's going to be split into the sources of the costs, right? So if you see the income that people get, the rent 20,000, the owner of the land is going to get 20,000, then employees are going to get 40,000, then those factories are going to get 20,000 for their machinery, then the farmer for his profit is going to get 20. So the total income in the economy is 100 as well. So that's why we say production should always equal to income. But that's not the same as spending, because sometimes people do not spend all the income. They're going to save some of that income, right? So production should be equal to income at all times, right? So what is it that I want to make in this case? All right, so we're going to discuss a bit about the decision making in the economy, all right? Because remember, the 3 fundamental questions in economics is what to produce, all right? How to produce it, and how to distribute, or for who. Right, so these are the 3 fundamental questions in economics that have to be answered. So the amount spent, the spending, right? The amount of spending or the demand determines how much to produce, right? It also determines to some extent what to produce, because the firms will produce as well on the basis of demand, right? So if there's demand for solar, then we have to answer that that demand is instructing producers to produce more solar goods and services. All right. So the amounts spent will determine what to produce and how much to produce. Right. So we are trying to answer those 3 fundamental questions. All right. So households do the spending. In most cases, households do the most spending, and they are also called consumers. You need to know that households are also called consumers. And when we look at the total spending of all households on consumer goods and services, this is referred to as aggregate consumption expenditure, the total consumption by households. And in economics, it is represented by the letter C. So when we look at consumption, source of consumption by households on consumer goods and services is represented by the letter C, the total aggregate in the economy. Right, so we assume about consumers that they are rational. This assumption means that they find ways to maximize their satisfaction given the income at their disposal. All right. So that's why we say in a market economy, then households also determine what is to be produced. When they make decisions, they're looking at ways to maximize their satisfaction. So they will choose those goods and services that are going to maximize their needs and wants. And firms are going to respond by producing those things that are wanted by society. All right. So that's our. Then we have firms. And we have discussed that they employ factors of production already. And we have an assumption that they act rationally. And as firms, that means they want to maximize profits. So when households act rationally, they want to maximize satisfaction. But when firms act rationally, they want to maximize profits. So that's an assumption. Right? And so firms also have expenditure. or consumption spending, they consume. All right. So they buy capital goods to be used in production. So the buying of capital goods to be used in production is called capital formation or investment. And all that capital goods that are bought by firms are represented by the letter I. All those capital goods that are used by firms are represented by the letter I. So this is investment spending. Remember, we have consumption spending by households and then investment spending by firms when they engage in purchasing of capital goods. So now we have two forms of consumption. We have C plus I. And we are looking at the total consumption in the economy. Right. And firms determine how to produce because they combine the factors of production in producing goods and services. They're looking at the lowest cost of production. Right. So remember, households determine what to produce. Right. But firms determine how to produce them because they want to produce those at the least cost possible, the most efficient way. So they are engaged in the production decisions and they're engaged in the supply side of goods and services. Whereas the households spend on consumer goods, they are focused more on the demand side. And they determine what to produce. These are focused on the supply side and they focus on how to produce those goods and services. Then now we also have the government, which is one of the players, which is obviously the public sector. So the primary function of government is very clear. They want to establish the framework within which the economy operates and provides goods and services. So they provide a framework. This framework might include physical infrastructure and laws and regulations, also values and so forth, which should obviously be laws and regulations. All right, so when the government is involved, it will be involved in three important flows in the economy. So there is government expenditure. So there's government expenditure on goods and services, which is denoted by the symbol G. That is to say, when they pay salaries for workers in government, when they're going to buy, let's say government wants to construct a big project, then they're going to buy a lot of things. All right, so they're going to be a buyer in both the factor and the goods market. They hire people. They also, so they buy, if they hire people, they buy the factors. They also buy the goods, normally capital goods, but sometimes consumer goods. So that spending by government is represented by the letter G. Then there is also taxes levied, which are represented by the letter T. All right. Then there's also transfer payments, which is not a salary, but to support the less advantaged people like your, what's that thing? There's grants, right? And unemployment benefits and so forth that are given as a by way of transfer payments, not pension, but basically transfer payments where we do a redistribution of income from the less privileged, from those considered privileged to the ones who are considered less privileged, right? So the government is responsible for government expenditure, taxes, and transfer payments. These are the three flows that are associated with the government, right? Right, then we have the foreign sector, which has to do with exports and imports. All right. So exports are represented by the letter X, then imports by the letter Z. All right, so if our exports are greater than imports, that is to say, we're getting more income from outside than we're spending, then that's a good thing for South Africa. The net effect is going to be positive for our country. Right? Because we're spending less than we are earning. When we export, we earn income from Germany or from wherever. Let's say Germany, right? Then when we import, then it means we're giving money to Germany. So if we earn more than we spend, then now that's a positive outcome. We're going to discuss that more when we deal with the international trade stuff. So the total spending, therefore, is made up of those four guys, all right? So consumption spending, investment by firms, government, exports minus imports. And this can be written like that as our total expenditure. So if you see this, remember this is from consumers. This is aggregate consumption spending. This is investment spending. This is government spending. This is exports minus imports, the impact of the foreign sector. Right, so quickly we're going to discuss the circular flow of goods and services. Firstly, we are looking at how goods flow between the various participants, right? So the role of firms, let me just write this, right? Because I see that my ink that I used there is not clear, so you won't be able to see that. So firms produce goods and services, right? And they sell them in the goods market. We're looking at the circular flow of goods and services. So the firms combine factors of production to produce goods and services. They sell this in the goods market. So the goods market is not a physical place. It's just an arrangement for buying and selling physical goods and services. All right. Like Facebook or Pick and Pay, if you go to the supermarket, that's goods market. If you advertise on your WhatsApp status, say, guys, anybody selling a fridge in this suburb, all right? And people say, yes, I am. It's here. Come buy. All right. I'm not. All right. So assuming this is a legitimate transaction, all right. I'm not trying to say you can do that, but I mean that's also a goods market. Any arrangement for you to buy goods and services is a goods market. So then those goods and services are bought by the households. We're looking at the basic flow. All right. This is the basic circular flow. And remember, these households, right, are the ones who provide factors of production to factor markets. In the factor markets, all right. So in the factor market, that is where they make themselves available. They make their ideas available. They make their, that guy, Vodacom guy, that please call me guy there. So his idea is one of that was bought in the factor market, obviously. That was made available to Vodacom, and Vodacom made use of that in its provision of goods and services. So that's why that guy wants his money now, because he should be paid for providing an idea, which is entrepreneurship, in the factor market. Right. So you need to remember that. So that was the circular flow of goods and services. So goods and services flow from firms through the goods market to the households, and factors of production flow from the households through the factor markets to firms. So look at the direction. I don't know what is clockwise. So I think this is clockwise. Right. So I think that is clockwise. My apologies to you, because I'm receiving this message that my internet connection is not stable. So what that means is sometimes you guys won't be able to hear me. That's the feedback my students tell me, that we couldn't hear you. So I picked up that when my internet connection is not stable, then you won't hear me clearly. So my apologies there, because I'm receiving that message now. I hope we'll be able to finish without a break. Right. Then that was the flow of goods. Now the flow of income is in the goods market, right? These firms sell and they get their income there, so we could call that profit. But from the profits they get, or we could call them revenue or sales or whatever. But from those profits or revenue or sales, they have to pay factors of production. So they have to spend in the factor market. They spend in the factor market, and the households are going to earn that income, right, from the factor markets and take it to the goods market for spending. So the circular flow of goods and services is clockwise. The circular flow of income and spending is anti-clockwise. It goes on the reverse. Where goods come from, that's where the income goes. Where factors of production come from, That's where the income goes. So you need to know the two markets, the factor markets and the goods market, and whether when the role of these two guys, the firms as well as the households, who is a buyer where, who is a seller where, what do they buy, what do they sell, what do they get. I don't think that's too hard, but you just need to be well prepared for that. All right, so we have shown you there that people are gonna get income and spend it, but they're not gonna spend all the income. All right. And some of the income they get is not the only income there is. There is more money they can get other than from the factor markets. All right. So they can get more money, all right, for spending, not only from the factor markets, but from somewhere else. So that's why we talk of injections and leakages in the circular flow of income. Right. So, for example, you have income. All right. These are firms. Right. What am I doing here? I can't even draw. All right. So these are firms. So let me say these are firms. And these are households. All right. So the money goes to the firms and the money goes to the households. All right. And this is the factor market. This is the goods market. All right. So if you look here, but the money that comes from these guys to, what is this, to the household, not all of it is going to be spent because they might as well save some, right? Or some of the money that they got, the households might spend it in Germany, not in South Africa. So we're looking at this circular flow from a South African perspective. To say the income that goes to the households will be spent in South Africa, but that's not always the case because people can go and spend in Germany, right? Or the government would be able to take some of that money through taxation, all right? So, which means that all the money that we received from our firms here is not going to be, what's that? It's not going to be pumped back into the system. Some of it is going to be saved, all right? So, which means that we're not going to be buying in the goods market. We're going to save that. We have spent, so this is savings, which reduce the income, all right? Which is reduces the income flow in the circular flow of income and spending. So we have our savings, we have imports, because if we import, it means we're giving that money out of the country. And then the government can take some, which is taxation. So these three are called leakages or withdrawals in the flow, in the circular flow. Right, so from these withdrawals, it means that our income left to spend is little, right? It's little, and as a result, we can only spend less. Then we also have what we refer to as injections, right? So in here, the government can introduce more, all right? Because the government is going to take this, what is this thing called? The government is going to take taxes, so it has its own income now. And it can inject those that spending, we don't know how much, maybe some of it. It's going to inject some more spending here, all right, on goods and services. Then the firms as well can inject more spending through their investment, all right. So instead of just consumption spending, we can have more than one spending. We can also have spending from the government. Because remember, we're starting from a basic perspective where spending is done by consumers, basically. But then we go on to introduce spending by firms, which is investments, which is investment by firms. So we start from household consumption, then investment by firms, then government expenditure, and then exports. Exports means now we're going to get money from another country to spend here in South Africa. So the volume of expenditure increases. All right, so you need to know those three sources. I think, yeah, sometimes they say three, sometimes four, but it's quite correct. four sources of injections. So it's consumption spending, right, by consumers, government expenditure by government, investment expenditure by firms, and export income by whoever has done the exporting. So those are the four sources of injections in the economy. All right. And remember those three sources of withdrawals or leakage. We have savings, we have imports, then we have taxes. Right. So we now in that system of firms, government, households, and foreign sector, we also have the financial sector. Now, the duty of the financial sector is to receive some of the savings from the households, from the firms, from government, or from wherever. If anybody who has savings, they're going to be channeled to the financial sector. Then the financial sector is also going to make investments. All right. So it's going to make investments. So questions that you most likely going to be asked by this, you stand a very good chance to get this, and then they will say label Z, C, and X. What are those things? So what's coming from all right, so what's going to the foreign sector? Right. So what goes out, because this is a circular flow, right? And something is going out here. So that's in leakage or withdrawal. So that's an import because it's going out to the foreign sector. So you need to identify this as imports. Then something is coming from other countries to South Africa. So we say, oh, that's our exports. Because exports, we're talking in terms of money, we're talking in terms of income, not in terms of the actual goods, because we're going to export coal to China. So the direction of the movement of the goods is from South Africa to China. But in terms of income, it's from China to South Africa. So we're looking at the income here, circular flow of income and spending. So we're going to get that. So this X here represents exports. This T here to mean households, something in the circular flow from households is going out to government. So that's taxation. But then government takes some of that and invests in the system. So that's government expenditure. Right. So your S here is also savings by firms. Your S here is savings by households. And the financial sector, your banks are also going to make investments in companies, which is I as well. So that's investment. So you should be able to understand that basic flow of income between households and right and households and firms, as well as knowing and being able to identify all those arrows. You should be able to do that because that's very important. So you should be able to identify the arrows as well as categorize them or classify them as either being a what is this thing that I was talking about? An injection or a leakage. All right, so you need to be able to do that. Brilliant. So where do we go from here? We almost finished. Now we come to economic theory. So what I want you to know about economic theory, you need to be able to identify the role or the three main purposes of economic theory. And also you need to identify the five macroeconomic objectives. So that's a very simple affair, right? So you need to be able to know that we're looking at economic growth, which is GDP, full employment. So we look at unemployment, price stability, and so forth and so forth. So that if you are given a statement, you should be able to see this relates to the equitable distribution of income, which is one of the five macroeconomic objectives. They tell you a statement that this happens, the government did this and that, you look, oh, this is this particular macroeconomic objective. So you need to know what price stability has to do with, right? In general, because then later on we're going to deal with all these items. We're definitely going to deal with them in greater detail. Right, then now we have a reasoning and logic in economics. So you look at this fallacy of composition, then but we're going to discuss the concept of causation versus correlation. So causation is when one thing causes the other, right? Correlation. So let me try to write it somewhere. Oh, let me rather try to read what I wrote because I think it will. So causation is one thing causes the other, right? Correlation means things move together, and we're not always sure whether one thing causes the other, but we just know they move together. But whenever there is a causation, there has to be correlation. So for every causation, if event A causes event B, then they will move together, because when event A moves, then B also moves. So when there is a causation, there is a correlation. Remember, correlation is moving together. All right. So where there is a causation, there is a correlation. But not every correlation, that not every moving together is a result of one thing causing the other. For example, here's an example. I think they got it from the textbook. During summer, right, birds migrate. That is during summer, and sales of ice cream increase. So as you can see, those two things are correlated. They move together. Birds migrate, sales of ice cream increase. But it doesn't mean, so the two are actually correlated because they move together. But it doesn't mean one causes the other. So if birds migrate, it doesn't mean they cause the price of ice cream to go up. Or if the price of ice cream goes up, doesn't mean birds are going to migrate. Right? So there is no causation there, but there is correlation. Correlation means things move together. All right. So it might be that those it might be that those two respond to something. Both of them respond to something. All right. So summer actually is the cause for bird migration. All right. And summer as well is the cause for what? For the demand for ice cream. So both of them are affected by one thing, but they don't affect each other. They both affected by summer, but doesn't mean that because they move together, one affects the other. All right. So this is some concepts of logic that you need to know. Also in life, this is very important, because if you see me coming out of your house and you go to your check your where you put your money and there's no money, it's very easy to that is a correlation, right? So it's going to be a correlation. That's a guy gets out of your house, right? And your money goes missing. So what you can say for sure is that this is a correlation, right? Or you can say a coincidence. And then you need an explanation as to why that is the case. Did one cause the other? Did the guy get out with the money, or what? Maybe somebody came in earlier before this guy and took the money. And when this guy came in, there was nothing to take. So, but we know that there is a coincidence. So I was saying here, it also helps in your relationships with people, dealing with people, reasoning. You don't just connect two things that because of this caused the other. It might be it's called a correlation, a coincidence. But now we have to determine whether there was a causation. And what we're saying is that so let me underline here. This statement is very important, right? It says causation implies correlation, but correlation does not imply causation. So things can be connected, right? Correlation, but doesn't mean one caused the other. That doesn't mean that one is a result of the other. They could be correlated, but once one thing causes the other, they will always be correlated. But if we start from being correlated, we cannot necessarily imply causation. So remember that. Now we come to what is it? So we have levels versus rates. All right. So a level is a balance, right? A level is a balance. A rate is a movement. So you can have an inflation level which is at 100. So there was this premier from Limpopo. I think that's a premier from Limpopo. People laughed at his statement, but I think you as economists wouldn't laugh at that, would you? Because there he says that, what does he say? Unemployment. So this is what the premier said, is increasing. Right? At a decreasing level. And everyone couldn't make sense of that. That's a very economics statement. You have something increasing. It's increasing at a lower pace, but it's increasing. It's going up, but it's at a decreasing, not at a decreasing level, at a decreasing rate. It's increasing at a decreasing rate. Okay. So basically, that means something might have been increasing at 10% per year. All right. It has been increasing by 10% per year, but this year it's increasing, but it's increasing at 8% per year. So yes, it's still increasing, but the rate of increase has decreased. So it was increasing at 10% per year, but now it's decreasing. It's still increasing, right? But at a decreasing rate. It's gonna be 8% increase, 6% increase. So it's increasing at a decreasing rate. And I listened to that. Obviously, you can't tell people that something is increasing at a decreasing rate and expect people to make sense of that. But this is what we discuss at a school. So obviously, as students who learn, you should be able to make sense of how something can increase at a decreasing rate. What's the difference between a rate and a level? All right. So a level is the current balance, right? And the rate is how that balance is changing. Okay, so it could be increasing at 2%. So if it is at 100%, if it is at 100, right, this is at the level. If it increases 2% this year, the next year it's going to be 102. So the level is now 102, but the rate was 2% increase. Then the following year it increases at 10%, right? We're just being general here. So now the level is at 112, but the rate was 10%, and the level is 112. All right. So the level is where it's currently at, but it's increasing using a rate. So the rate feeds into the level, right? I hope that does make sense to you. All right. So the rate of change, we are looking at the right. Apologies for that loss. I think we're almost finished and we're gonna be surviving this. So a rate of change, we're looking at the current value over the previous value minus 1 times 100. Right, so I'm gonna give you examples of rate of change. Right, so this is the examples of percentages. I'm gonna give this to you so that you can calculate that. Right, so yeah, I think I took this from the textbook or study guide, just for the purposes of an example. What is the percentage increase or percentage decrease? All right, percentage change. So this question, let's do it together. It wants us to determine the percentage change in the number of sparrows observed on April 25 and 23. So April 25 is 183. Now it's 156. So the change is going to be the current one, right, is 156 over 183. Remember, change is always the recent value over the order value. Then after you get this, I want to make sure I write it correctly so that it's not misleading. So it's 156 over 183. All right. Then you subtract 1. Then the answer you get, you multiply by 100% to make it a percentage, right? Right. So that's how you get an increase of anything. So if you want to look at these birds, they had data, I think. So it's going to be 27 divided by 24. Right. Then whatever answer you get here, you subtract 1, you multiply by 100, the answer. Or you can start by saying this new value minus the old value. Right. So you're going to say the new value minus the old value over the old value. All right. Multiplied by 100. It's exactly the same thing. So that is also about the same thing when you look at the rate of growth, rate of change, how the things changed. In 2020, so the South African economy, we're coming from 2019, we're going to 2020. So that is COVID, right? So we're going to say the new value is 850 over the old value, 1150, right? The answer we get there, we subtract 1. The answer we get, we multiply by 100 to get it a percentage. Or we can start by saying the new value, which is 850, minus the old value, which is 1150, over the old value, which is 1150. And you see that the answer is going to be negative because there was a contraction of the economy. So basically, that's how do you determine a percentage change or a rate of growth. All right, so that's some of the things that you must know. So in your assessment, they're going to give you what percentage of this is that. If something grows by 5%, what is its new level, and so forth. So it's all about levels and rates of change. And I believe that with practice, you should be able to. That's not too hard, right?